How to build a billion-dollar hospitality business. We're talking about that and more today here on the Commercial Real Estate Report. I'm your host, Chris Berg. We're here to empower you to go out and build generational wealth with real estate. I'm the head of business development with Abernathy Holdings. We're going on building, developing Class A self-storage sites in California, Arizona, and soon to be beyond. Excited to have our guest with us today. He is the CFO, Chief Financial Officer at Tharaldson Hospitality, Tharaldson Investments. Full disclosure, our guest is also part of this great book, The Story of Gary Tharaldson. Gary Tharaldson is a joint venture partner with us here at Abernathy Holdings. But Joe Blagg is our guest. And Joe, it's great to have you.
Great to be here, Chris. I look forward to chatting with you today.
A lot of great stuff. We were just chatting before we went live here. You were talking about the incredible numbers of hotels that Gary has built from, I think you said 1982 to 2022. So let's just start there to give people an idea of the breadth and the incredible success that's happened at Tharaldson Hospitality.
Yeah, so we had a company event in the summer of 2022 to mark Gary's 40 years in hospitality business, and from 1982 to 2022. He has built, owned, and operated over 480 hotel properties. so averaging about one new hotel a month for 40 years, which is it's pretty mind blowing.
That is that is a staggering data point. Like how? I guess that's how did he and you guys go about doing that?
Obviously I wasn't there for the early days for the first 20 years, but really just with Gary, he talks about it. It's a dream, and the combination of just determination, hard work, and then an incredibly big appetite for risk, obviously, to just keep going, and yeah, it's pretty impressive.
I want to get into your story and when you started with him, but you brought up appetite for risk. And I think what's really interesting about that, if you were to talk to Gary, he doesn't necessarily see it that way, right? Like he's like, look, I know what I'm doing. I know my numbers. I don't really see it as risk. There's risk, but maybe not to the same level that, an average Joe might interpret it. Is that a fair assessment?
Yeah, that's fair. I think, Gary's got a lot of sayings that kind of stem from the Midwest background, and one of those is stick to your knitting. Once you know what you're doing and you've done a few hotels, like you said, it doesn't feel like risk to him, because he knows what he's doing. He knows what's going to be successful. In real estate and business, we always say that past performance is never indicative of future results, but once you do it a few times and you kind of know the parameters, and what's going to make a good location and a good market, and sticking, what he always emphasizes too is what we've done is sticking with the best brands within our bandwidth of hospitality. The select service extended stay brands with Marriott, Hilton, and IHG, which are the three biggest franchise companies and three biggest brands in hotels around the world. And not doing anything too far outside of that box. We've stayed away from full service and resort hotels. We've stayed away from kind of doing anything that's outside of repeating what's been successful for us in the past.
Well, I think you bring up a really interesting point. Like within the book, it talks about it, but where if you talk to Gary about, okay, what we would call your buy box, he's just got it so well narrowed down and niched. And not only the buy box, but then he obviously was masterful in saying, okay, not only are we going to put up an hotel here, but we're going to put up one next door. So when this one fills up, our managers can just sort of slide people over here, but different brands. So it was just a really incredible strategy.
Yeah, he's obviously, most of the last 40 years, you want to take advantage of the reservation systems that these incredible companies have built. So there's no reason not to put a Hilton next to the Marriott, next to the IHG property, and then if it's a good location and a good market with plenty of demand, you might as well take advantage of all the various ways to get market share.
And one hotel every month for 4 years. I'm still just blown away with that.
It is pretty unbelievable.
It's just stunning. I tip my hat to you for being a part of that. We'll talk more about some of the incredible numbers you put together as well as part of Tharaldson Hospitality. So let's go there. I mean, tell us about a little bit about your real estate story. When did you start at Tharaldson Hospitality, and how'd you end up meeting and working with Gary?
Sure. Yeah. My background's in construction. My dad was it was and is still a contractor, construction manager doing, residential and commercial projects. And like most people, you once you grow up in one area, you kind of want to get away from it. And after I went to college, found myself right back in working for a couple of small developers. So between the construction background and degree in finance and some of that experience, I moved to Las Vegas when my wife and I decided to get married from Southern California, where we were living, and worked for a small developer here doing multifamily and self-storage and a few other asset types. And I came to know there was a group here in Las Vegas that Gary had invested with, and then eventually had bought a majority stake in the company that was doing similar developments, multifamily condo projects, some retail stuff. And they were came across those guys that were working for Gary, and they were looking for another, project manager, asset manager type, and just seemed like a good fit. So went to work for them in early 2007. Right before all the real fun stuff began. And around that time, Gary was more or less kind of getting out of the hotel business. He had sold, a big portfolio of properties to the employees through an ESOP in 1999 and 2000, and had continued to develop hotels, and had another big portfolio of 131 properties that he had sold to Goldman Sachs in 2006. So he was divesting a little bit, and had a few different investments and developments, and these projects out here in Vegas and Phoenix were part of that. And so he no longer had his giant company with all the hotel employees and the development employees that had all kind of gone as part of the the ESOP company. So we just had a small office here, and he came to us. We were doing some real estate projects for him, and he came to us and said, "I've got this big real estate problem. I've got this sale to Goldman Sachs, and which is a $1.3 billion transaction, and about 500 or 600 million of that was eligible for 1031 exchange, deferred capital gains exchange into real estate." And he wanted us to help him figure out how to place all that. So we we spent some time placing all that into a lot of larger tracts of land that were mostly land development projects around the Southwest, Colorado, Texas, a little bit here in Vegas, a little bit in Arizona, and one project out in Atlanta, Georgia. And then when we had the financial crisis starting to emerge, Gary went from having all these operating cash flowing hotels, which was, obviously a lot of employees and a lot of big management issue, but into having a lot of assets, a lot of land, not a lot of assets that were producing, recurring cash flow. So we went through those challenges with the banking crisis and not having a lot of liquidity. So, some of that was a little bit baptism by fire for for most of us, and trying to keep everything afloat without much liquidity and a lot of entitlement and asset management headaches to get through the other side of the recession there.
If you would, take us into a little bit more of the details of that, because 1031 exchange, you've got a limited number of time to deploy the capital, correct?
Correct. Yeah, you've got 45 days to identify a replacement property and 6 months to close.
So I come to you with $531 million. I mean, how do you go about deploying that much capital in that short of a window and doing it, somewhat remotely successful? But then you bring up a good point. All of a sudden we realize, hey, we've got all this land. There's no cash flow. Like, this could be an issue.
Right, right. Well, and Gary's always had great relationships with banks and lenders, and he's obviously, built the empire with using as much leverage as he could. And when, some of those banks that we had lines of credit with got shut down by the FDIC, and because they were heavily invested in, residential and development real estate, and we all know what kind of happened there in '08 and '09. So yeah, the 1031 process was, you realize pretty quickly you can't do small deals. You gotta go buy these, bigger tracts of land. We came up pretty quickly with a rough plan of, we want to be in the Sun Belt where these major metro areas are growing, like Denver and Austin and Houston and Dallas, Fort Worth, and really, I think to do about 40, we ended up doing about 40 deals as part of that 1031 placement. But to do 40, you got to look at 250, 300 to figure out which ones make sense and are a good fit, and negotiate with sellers and all that good stuff. So it was obviously a lot of work and a lot of fun, but yeah, very fast moving time.
So, and I think you've got a really good piece of dirt over in Arizona near Phoenix. And if I remember correctly, Gary shared with me a little bit about that story. Just had some interesting pieces to that sale. Can you talk about that?
Yeah, we've got a couple. I mean, a couple things in Phoenix that we when we started doing the land development stuff as part of the 1031 exchange, Gary liked the idea, and we ended up doing some additional land investments and stuff that was outside of the 1031, just because we kind of had the team in place and might as well keep going like he did with the hotels, right? So we've got a piece, we've got a bunch of farm ground out in Harquahala Valley, that we're, part of a collective out there. A lot of that's irrigated farm ground that, was originally looked at as maybe it's development land at some point, with Phoenix Grows, but it's also got water rights. So that's, long-term value assets. And then we're part of, another big, 12 or 13,000 acres out in Sun Valley, which is just north of Buckeye, that, will eventually be development land. Howard Hughes is developing a big master plan out there
Wow.
adjacent to us as well. So, yeah.
And I think you were there. It sounds like it, because there's a story in the book where Gary basically has to call up his secretary and go, "Hey, I think we might have to file BK." Were you there during that time? And if so, what was that like?
Yeah, that was 2011, 2012. We had a bunch of things going on. Gary had built the ethanol plant. Talk about some of those things that were a little bit outside of the box that you look in hindsight and go, was that a great idea? It's turned out to be a great idea and a great asset. But in the beginning, during that financial crisis, it was an issue. And taking up, a lot of cash flow to keep feeding it. That ethanol plant opened in December of 2008. So from 2008 to 2012, it basically lost money, and we had to keep investing more capital in it. And at the same time, Gary had arranged, this is other stories in the book too. Gary had arranged, he was doing some hard money lending with two developers around that time too. We had done a condo project on South Las Vegas Boulevard called Manhattan that was very successful, mostly because of timing, right? Um, Sold out 700 units in 28 days, and everybody was happy with that. And one of the co-developers of that project, was doing another project called Manhattan West that Gary and a mortgage broker had arranged for, a big, construction financing deal that had participations with a bunch of different banks, and Gary was also participating in it. And part of that was Gary had personally guaranteed that. So when, we went through years of this liquidity crunch and financial crisis, Gary had some advisors that were basically telling him, you need to file bankruptcy and get rid of some of this stuff that otherwise it's just going to be a long process, and you're never going to get out from underneath it. And so he was pretty close, and kind of outlines that in the book a little bit, but decided at the end of the day, he had built built his empire and his whole career with great relationships with banks and lenders, and just didn't want to go down that path, and said, no, look, we'll figure it out. So was able to kind of come to a settlement agreement, and which involved a lot of encumbering of other assets, and paying back the banks in some tranches and over the years, and got basically made everything whole. So
Wow. So what's the most number of hotels you've had under development at once, and how are you managing that process?
so in 2012, 2013, Gary had some sites to build new hotels, and the financing for new hotels had kind of started to wake up a little bit around those days. So had built a few, starting in 2012, 2013, and then in 2015, February of 2015, the first portfolio that Gary sold was the ESOP, sold to the employees, and he carried back basically his equity in those hotels. He carried as subordinate financing long term to for the ESOP company. And in 2015, they closed a sale of that company to Starwood Capital. The ESOP did. So Gary got paid back all of his long-term subordinate financing that he had held all those years, for about 15 years, which was close to 300 million. So it was a big, nice big liquidity event for us, and we were ramping back up the hotel development, and kind of got through the other side of the recession. And Gary said, the hotels have really always been the best business for me. Why don't we rebuild that portfolio and get back to where we've got nice chunk of cash flowing hotels to help us do everything else we're doing. So when it became imminent that transaction was going to close, and we were going to have this big liquidity event, that's when Gary really ramped up, and he said, I have done a couple portfolios that were big, both well north of 100 properties. It'd be nice to get back to somewhere near that 100 hotel number. So we went to work finding sites, and spent a lot of time in California and a few other markets looking at hotel sites. But at one, for a couple years there, we had over 20 hotels under construction. So close to 35 or 40 in various stages of development and planning. And like we mentioned earlier, when COVID hit, we actually had 22 under active construction when the world kind of stopped there.
How are you going about managing that? Like, what are some of your processes?
We just, we've got everything. We do everything in house, more or less. We've got a construction company in house so we're our own general contractor. We sub most of the labor out, but we do all the purchasing. So we've got a pretty good infrastructure for construction management, in house. So we do what we've always done. We lean heavily on our people and on our expertise to manage through it. That was obviously a challenge, and there was a lot of projects there that obviously got delayed because you couldn't get city inspections, and we had about 6 months there where everybody, if one employee for a subcontractor tested positive for COVID, the whole job gets shut down for for several weeks. And so there was a lot of those challenges that we managed through, but we got through it.
So all those projects now are complete?
All those projects that were under construction during COVID are now complete. Yes. Yeah. And then we've got another 8 or 9 under construction still. We're still, kind of working our way through the big development pipeline that we built back in 2014, 2015, when Gary hit the go button. So,
You mentioned California. I think you were born and raised in California, correct?
I was, yeah, Bakersfield, California.
Born and
South.
raised, lived there for a while. Talk to me about your experiences. Like, how many hotels have you personally been a part of in California, or other maybe projects as well? And I bring this up because when I told people, hey, I was going back out to California to build storage, literally would laugh at me. Like, are you crazy? What in the world are you doing? And, Gary would say he's like, that's exactly why we want to go there. It's got a high barrier to
Right.
entry, so what's been your experience?
Yeah, high barrier to entry has been the key. The key when we first, we're looking at, okay, if we're going to build another 80 or 90 hotels, where do we want to be? For most of the value that we have in our hotels is not in building it, it's not in selling it someday, it's in the operations, right? That's kind of the key for us, and we operate our hotels in-house as well. So if we're looking at it from a perspective of we want to own and operate these hotels for 30 or 40 years, which was Gary's perspective and his outlook. We want to be in areas that are obviously good markets, obviously high occupancy markets, but also those high barriers to entry. So if we're going to go and build a new hotel, we don't want to build in a place where 5 years after we open, there's 3, 4, 5 new hotels that are in our competing bandwidth in that area. So a lot of markets in California made sense. We knew it was going to be hard. We knew it was going to be expensive. We knew it was going to take a long time. But like we said, once you actually stick with it and get it built, then it's a good asset for a really long time. So yeah, I mean, a lot of hotels that were under construction now or have recently opened in California, we started land acquisition and site planning and entitlements back in 2015, 2016.
Come on.
Yeah, so it's a lot of those deals, they take 5, 6, 7 years before you're actually under construction.
What?
Yeah, it's which is like you said, which is why a lot of people aren't willing or don't want to go do that because they don't want to. Number one, you beat your head against a wall trying to get city approvals and entitlements, and two, it's risk. You have to spend real money to get to that point, to get to the point where you might be able to get a building permit for a hotel. And a lot of those, yeah, you got to spend half a million, million five.
Five
And
to 7 years for entitlements and building permits?
correct. Yeah.
Wow. We
Yeah.
thought it was long in storage. Like it hasn't been 5 to 7 years yet. So maybe we'll find
Yeah.
some of those sites, but not yet.
Yeah. It's not usually quite that bad in a few other states, Arizona, Nevada, but California is definitely in the markets you want to be in, right? In those
Right.
cities that obviously have a lot of development processes. And a lot of these hotels we built, it's the first hotel in that city in 20 years, and it's probably going to be another 20 years before the next one gets built. And that entitlement and approval process is why.
So some investors out there might be going, how in the world are you guys getting good returns, using those kind of timelines? I think that's a really important piece because there is no outside investors, right? It's been all Gary's money or bank money. And
For the most part, yeah. Gary, I think he said he did his first 375 hotels or so without any outside investors. We did bring in an equity partner back in 2012 when to get the first few projects going, and they've been a great partner. We've had a great relationship, so we've continued to do some hotels, but the majority of the hotels don't have any outside investors.
so what kind of financial metrics are you looking at as you go in? You've got these potentially 7 year entitlement process, building permits. You being the CFO, what makes you say, okay, this project makes sense financially, let's greenlight it. This one doesn't.
Well, there's various stages where you have to look at that, right? You look at it when you're first looking at a site in a market, you run your initial model based on what the metrics look like then with construction costs and interest rates and, what the hotel rates and occupancy are doing in that market. And then as you're going through the entitlement process, once you say this is a good site, we like it, this is a good market, we can get a brand we want to do. You obviously update that along the way. We've got some deals that were under construction now. It's some of these construction budgets are double what we had forecasted 6, 7 years ago, but the occupancy and the rates have also gone up quite a bit. So there's various sort of stages where you have to be willing to get to certain checkpoints and say, does this still make sense? What does the market look like? What do the numbers look like? And there's some, not very many, because I think we did a pretty good job up front. of identifying good markets. But there's some that you get to the, you get all the way down the road, and you've obviously spent some real money, but you get to the point where between financing and construction costs and what the market is doing, it doesn't pencil, and you've got to be, willing to both take the risk to get to that point, but then also, be able to say, okay, this doesn't make sense. Let's put it on the shelf and go look somewhere else.
So I'm fascinated to find out more about your underwriting process because we're having this conversation internally right now within Abernathy Holdings. And so, we typically look at, hey, a entitlement construction process, maybe 2 years, you're talking 5 to 7. So when you're underwriting it, are you underwriting it at today's hotel rates? Or are you saying, oh, you know what, we're not going to get up and running for another 5 years. Let's underwrite it with a 3% growth every year and 5 years from now. Like, what's your underwriting process like?
Yeah, I mean, short answer, we kind of look at both, right? We look at what does this look like if we were going to start construction tomorrow, and then what does this look like 3 years from now, and assume, make building in some assumptions on cost escalations and rate growth and revenue growth. You have to kind of be able to look at it a few different ways, right?
And how have rates, meaning interest rates, impacted your business today?
Significantly. I mean, we were 2 years ago, construction financing was, 4.5%, and now it's 8. So that obviously is a big deal. Again, from our perspective as not a merchant developer, but a long-term hold, we can build in some of that and where we think interest rates are going to go 2, 3, 4, 5 years from now. But it's certainly impacted it. Between interest rates and construction costs, which have not slowed down, it's definitely, making some deals difficult. And we're obviously not the only ones. There's our competitors out there and are seeing the same thing we are, and I think it's, if anything, it's going to continue to restrict new supply until the metrics kind of normalize and get built in. So I think you're going to see a pretty good restriction on new supply over the next 2, 3, 4 years.
Which is frustrating because when it's like that, you're like, I just want to keep big building, right? Because there's going to be restriction on supply. So how do you get some of that key points? Back to the underwriting. As you're underwriting, what's the most important, or maybe 2 or 3 most important metrics you're focused on as you're doing the numbers? Is it IRR or what are they?
Yeah, I mean, we certainly look at IRR. And all those kind of are kind of connected. So we look at a IRR on like a 10-year hold, and make some assumptions on the exit. But you also have to look at, everything is based on financing. So you have to look at debt yield. You've got to look at debt service coverage. You got to, all those metrics need to sort of be in a window before you're interested in really taking a risk and moving forward on some of those projects. But
And are you going in with, okay, this is going to be a 10-year hold and we've got an exit strategy in place, or we're going in with a mindset of a 30-year hold and who knows if we're going to exit?
we have, the last 10 years, the development mindset has been, we're operators, so let's look at this as if we're going to hold it for 30, 40 years and operate it. We know that's probably not going to be the case at some point. At some point there's going to be a good time to, sell, maybe not the whole portfolio, but a chunk of it, or something like that. But I think it's a lot easier and it's a better mindset to not try to time the market. I mean, most merchant developers that's what they're doing. They're trying to time the market cycles, and when you're raising outside money, multiple tranches of outside investment, a lot of times that's dictated to you. It's got to be a 5-year or 7-year turnaround. So we look at it a little bit differently, and just knowing that, hey, the market's going to dictate to us when a good time to sell is. And we joke about probably my favorite saying in real estate, which is the best time to sell is when you have a buyer. and you'll know, kind of like '06 when Gary sold the portfolio. He wasn't initially looking to sell that big portfolio, but when groups start offering you more money than you think your asset is worth, that's when it's time to think about selling, right?
Just a couple more questions. And Joe, again, thank you for the time and the insight. What do you love most about real estate?
For me, it's like every day is an adventure, right? Every deal is different. Every project is different. Everything we work on has a new problem to solve that we've never encountered before, which for me is why I've stuck with it and really enjoy it. It's not the same thing over and over again, and we rise to the challenge. We love hard things that are difficult that other people look at and say, ah, that can't be done, or so for us, that's what we really enjoy.
If you're building in California, that's abundantly clear, right? Hey, we,
Oh
we,
yeah.
love, we love doing it the hard way. For newbies out there that are thinking about, getting into real estate, maybe they're new to real estate investments, what would be your wisdom for them?
I mean, for me, it's always been about research and knowledge, and you can't read and learn enough about any asset class or any process, and obviously having an open mind and having the mindset that you're never going to stop learning. You're never going to be an expert, right? No matter how much of an expert you are, there's always new challenges and new things to learn. And for me, I think it's probably not just real estate; it's every industry, right? Having that curiosity and willingness to just continue adding knowledge to your bandwidth.
Boy, I said just a few more questions. So just a few more, because now that you open this door, I'm curious, what do you think is going to happen within the office space? Where do you see that going? And is there any particular asset class right now that you have your eye in there, like, oh, that looks interesting. It's kind of in its infancy, but that's one I'm going to keep watching.
Yeah, Office has obviously been the headline since we came out of the other side of the pandemic, and it's not something that we've historically developed or invested in. So, but I think you're going to continue to see the trend of conversion of Class A office space in city centers, central business districts. But at the same time, suburban office has never been in higher demand. And part of that is the reframing of the commute and employees' idea of how they want to set up this remote work hybrid model of okay, I'll go back to the office 3 or 4 days a week, but I don't I don't want to drive for an hour into the center of town or take the train or whatever. I want it to be closer to my house. So we're seeing a big kind of shuffle of that, and it's going to take some time. I don't think you're going to see this instant bloodbath, in office space. It's going to take some time to chew through it and convert a lot of that stuff. And as far as the other asset classes, I mean, the asset classes we're in, I still really like self-storage and hotels and the land development stuff. I don't see any slowdown of the development for single family homes. And most major MSAs have had a housing shortage for a really long time. So it's not going to slow down anytime soon.
What do you like most about self-storage?
What we really like about it, what Gary really likes about it is the management aspect. In a hotel, you have 30 employees. In self-storage, you have one, and eventually, you're probably not going to have any on site with the technology advances we're having in automation and all that. So I think for us, it's coming from the development side and the management side of the hotels. Self-storage seems simple. It's obviously not. It's still development and it's still asset management, but it seems a little easier. And it's an asset class that my first development project I did 20 plus years ago was a self-storage facility
Oh, I didn't know
in Las
that.
Vegas. Yeah.
Really?
Yep. We did a few out here that we sold just in the nick of time before before the recession. But yeah, it's an asset class I've always liked from a development and ownership perspective. Know,
Yeah, and it's one of the few asset classes with a
it's in
lot.
demand in good times. Right. It's in
Yes.
demand in good times and in demand in bad times. So, which
Yeah.
we kind of look at our bandwidth of hospitality the same. it's not recession proof, but it's recession resistant.
Very well said. Anything else you want to add or share? I just want to give you the last word.
No, I don't think so. Appreciate the time, Chris. It's great having a chat.
Yeah, it was very insightful, man. And again, it's ringing in my head. One hotel a month on average for 40 years. I just want people to die. It's just incredible. So
It really
congratulations
is.
on all your success, man. It's been fun to watch from afar. Very grateful getting to know you. And thank you for your time today.
You too. Take care, Chris. Appreciate it.